Ladies and gentlemen, welcome, welcome, welcome. My name is Andrew Kelly. I'll be moderating this session, but I'm delighted to have such a good panel around me and beside me. I'll introduce them, or they'll introduce themselves in a minute, but I should introduce myself to start off with. I've been in the investment world for a long time, not initially in what you would have called impact investing, more in mainstream venture capital, but always in that food and agriculture space, particularly the gap between food and health. Our fund is also now beginning to deal with many of the global corporates and assisting them to understand the good things that are coming out of this part of the world so that we get more of their investment in one form or another. The panel I will get to introduce themselves, but you'll notice on the way past that they actually have a very diverse set of backgrounds, and also they've all come into the industry from 4 different directions. In fact, there is no career path to get into impact investing. These people have found the space. I'll be asking them a little bit of a question about why they found the space and how and when they moved into it, but that'll be illustrated by the audience, by the panel today. I'd also like to start with a brief discussion about a definition here, and I hasten to add there isn't a nice, crisp definition. But in a sense, impact investing is financial investment, distinct from philanthropy or grant investment, but it's financial investment aimed to achieve impact in addition to the conventional financial returns. It's the balance of those 2 forces that is where the discussion or debate lies about how impact investing is defined, that balance of impact and financial return. I'll be exploring that with some of my questions to the panel. I guess you can consider impact investing as a bit like woke venture capital. It's sort of like what you can do when you think about how to actually use that money in other ways than just seeking financial return. The aim of this session is to shine a torch, or for Victor, a flashlight, on the area of impact investing. It is a relatively new area, new terminology at least. There's been a lot of impact investing over decades, but probably as recently as the mid-2000s, the term impact investment arose. And our aim today is not only to explore this area, but also to inspire. And I'd be delighted if there were founders, entrepreneurs, or people interested in that space in the audience, if towards the end of the session they really do start to engage and ask questions of their own, because it is an area that needs exploring, and I hope this session will inspire people to participate in it in some way. I will, from left to right, ask our panel to introduce themselves, but I want you to do 3 things when you're introducing yourself. I want you to mention your immediate prior role, the thing that you were doing prior to moving in. I'd like you to mention when you moved in, and then I'd like you to describe your role. Could I start with Adam? Adam Gregory, sorry.
Thanks, Andrew. So Adam Gregory, for my sins, I had a 16-year investment banking career with Goldman Sachs, where I covered consumer, retail, food and healthcare, and headed up that part of the investment banking team in Australia and New Zealand until 2016, when I left Goldman to set up a family office with a client and started working on the investment side. Around that time, about 2.5 years ago, we seeded an impact fund, and I now chair the investment committee of that fund. And we started taking external capital around in May this year. So we have about $40 million under management, and our focus in impact, and there's varied people target different places. We focus on solar, agri, and healthcare, aged care, affordable housing. So where we're trying to operate is in the space that where you can generate cash flow, where you can, as well as making a positive contribution. So a lot of venture capital, a lot of impact investing focuses on earlier stage opportunities and venture capital style opportunities. We focus on more established business opportunities. And so we're looking to replace the blue chip part of people's portfolios, replace their property portfolios and their maybe their infrastructure type investments, and so our fund since inception's earned around 10.4% per annum and is very cash flow focused with a 6% yield. But at the same time, we've taken the equivalent of 3,400 cars off the road. We've mentored 900 young people who were long-term unemployed into new roles. And we've contributed to building around 1,000 beds for people who need affordable housing or aged housing. So that's the way we think about impact, both the financial return, but also what is the social and environmental return.
Thank you very much. Rachel Yang from the Impact Investment Group.
Hi everyone. Directly before I joined the Impact Investment Group, I was in management consulting and focused on infrastructure advisory. Prior to that, it was broader management consulting, predominantly to Victorian government on policy programs, business cases, etc. And had started a not-for-profit to raise funds and awareness for motor neuron disease as well. So all of that kind of brought me towards wanting to do more in the impact space with the business hat and the agility of starting your own business. Like for me, it was the not-for-profit. And then also the transactions that I did in infrastructure advisory, I kind of tried to combine them all together by moving into impact investment. So I joined the Impact Investment Group a couple of years ago. We have 3 divisions that we invest across, and I should say we're a funds manager. The 3 divisions we have are property, renewable infrastructure and venture capital, and I sit within the venture capital team. And we have one fund called the Giant Leap Fund. We have $15 million in committed capital. We invest across 3 themes: health and wellbeing, sustainable living and empowering people. 13 portfolio companies to date across those 3 themes. So they're very diverse. They span from things like GoTerra, which I was telling these gentlemen about before, which is a company that breeds black soldier flies to consume organic waste, so a waste management business using maggots. We have a medication adherence app that gamifies the process of taking your medication, a recruitment platform that strips unconscious bias from the process to aim to make better hires. So that just gives a brief snapshot of our portfolio.
Thanks, Rachel. Terry Paul from MyCo.
Yeah, thanks, Andrew. My background's a little bit different to what we've heard so far. I guess I'm lucky I sit at both ends. I'm chairman and co-founder of a business called Findex. Some of you may know that. We're the 5th largest accountancy business here in Australia. It's quite a big business these days, with 3,000 employees and about 120 offices between Australia and New Zealand. But most of my time these days is spent in what I call startup land. So we basically concentrate on health and wellbeing and food and beverage businesses. You're drinking some of our water along in this conference, our botanical water. That's one of our investments of a couple of years ago. And you probably at home got our bio cheese, our plant-based cheese in your fridge, and some of those products. And in the middle years, this answers your question, Andrew, I also was crazy enough to get involved in specialty dairy business called Lemnos. In those days, Mediterranean lifestyle was quite new to Australia, and we developed a feta and halloumi, which no one knew about, which is now pretty regular cheese, because McDonald's actually sells halloumi burgers, so that proves it. Our main focus is, the attachment is, I'm a grumpy old guy these days who likes to probably give back a little bit of what we've taken out, and that's really the interest in impact investing, both in social, environmentally, and especially philanthropically. Thank you.
Thank you. And finally, Victor Friedberg, who's come to us from a combination of San Francisco, Chicago, and New York.
Yeah, I'm not quite sure where I am at this moment, but I'm on stage with some great people, so I was happy to meet everybody. My name is Victor Friedberg. I was trying to think of where I was prior to what I'm doing, because it's kind of, your career sometimes are a continuum and there aren't actually discrete parts, but I guess the one I'll point out is I was a cool hunter at Wired Magazine, which might have been the greatest job I ever had. I got to fly around the world and basically meet cool people doing cool things in technology and science. But went on to found a fund called SDG Ventures. My thesis was around systems investing. So how do you invest in an entire system as opposed to individual companies? My first investment there was a small little El Segundo company called Beyond Meat. That has been an incredible insight into the changing dynamics of the food and agricultural industry by and large. Now what I'm focused on is launching my nonprofit, which is called Food Shot Global. It's a consortium of the world's leading banks, foundations, funds, corporations, universities that collectively address one big food system issue every year. And we've created a blended capital platform of prize dollars, equity, and debt to take big ideas, high risk, high reward, high impact companies from research all the way to growth companies.
Thank you very much. I'd like to move into a little bit of a discussion on definitions, but I like the way Rachel used a specific example. Would any of you three gentlemen have an example of a good impact investment that you're familiar with that you'd like to illustrate?
Impact investment?
Yes.
Well, should I start getting controversial because I don't believe in impact investing? Is that a good place to start?
That's a great place to start.
So I don't look at investing, impact investing as a separate class or separate set of techniques or outcomes. I just believe that the high growth companies of the future are all going to have impact as a byproduct of what they do. Because the consumer has fundamentally changed and they want things that are value-based and around sustainability, about affordability, about nutritional density, around traceability. All of these attributes are where all the growth is. So as an investor, I look at it as just opportunity for return on investment, and then all of the impact comes from what these companies do as the fundamental DNA of who they are. So it's just a different view of it, but I'll stop there. Yeah.
No, that's good. Terry or Adam?
I don't think that's all that controversial. I think that it's where we sit on the time continuum, and hopefully in the future, what you talk about is exactly right, and that is, and all companies do that. I think just at the moment, the reality is that they don't, and I think our philosophy is that we need to start measuring impact, because if we can't measure it, we can't manage it. That is the old saying, and so. Certainly the way we think about things is where when we talk about impact, we talk about it's still delivering a return. So impact is not philanthropy, and it's not about concessional returns, it's about market returns, but we also want to measure the social or environmental impact that we're having in an objective way. So we're reporting both on the financial return, but also on the social and environmental benefit. And I think as more people as more of us do that, there'll be a shift in mindset that's happening already, but hopefully it speeds it up and everyone starts doing that. And so in the future, we're not talking about impact investing and traditional investing, we're just talking about investing.
And just one sort of historical note, and sort of part of my little bit of pushback on the concept of impact investing. Historically, the people who were impact investors or family offices or funds really use the need for metrics as the sort of the gating principle for releasing the money into investments. And the problem was a lot of the abilities to measure things and to have metrics just weren't developed quite yet. So a lot of that money stayed on the sidelines for years and years and years while these ideas of how to measure it, sort of evolved. So there's a lot of debate around how to measure things, which is great because I think that's how you hold companies accountable. But for, I think, everybody on this stage, what we want to see is that money go to work and to go to worked faster and then let the metrics come after that, as opposed to being a gating principle to release the dollars in the first place.
Yeah, I agree with that. I think the way that we look at it is in the contracts that we have with each of our portfolio companies, we agree to collaboratively set metrics once we've invested together to make sure that the metric itself is useful for the business. So an example for that, linking to an example I've already used about GoTerra, the metric itself is tonnes of organic waste diverted from landfill. So they measure that as part of their business anyway, and that's how we look at impact. It needs to be embedded in the business model so that the metrics are manageable, measurable, ongoing.
And I think Adam sort of hit the nail on the head in terms of embedding impact into the whole process. So you've got the dynamics of impact investing. I think everyone agrees with it's a good place to be and whatnot, but all the dispute, all of the fuss, if you like, is around the mechanics. How do we do that? And everyone's got a different way, a different style. It's actually a bit of a mess when you think about it. I mean, everyone's going to have an opinion there, but I lend a bit, Andrew, out of financial services. So you see in Australia there's a lot going on in that industry in particular with, royal commissions into banks and a lot of it's around regulation and compliance. And organisations that embrace compliance rather than run away from it tend to have a happier life. So if mainstream investing embraces impact, all of the triple bottom line type issues, they're going to have a better life. They're going to be a better business. They're going to be impact their consumers, their staff, the culture, the way they go about it. It's like they'll be a fitter athlete. They'll be running marathons, not just walking around the block. So that'd be my take on it.
Okay, I've heard that, and now I'm just sort of thinking about the difference you're trying to say about impact investing from traditional, and having come into this from the traditional side, I know I could fill this panel 7 times over with mainstream VCs who would just have all sorts of elegant things, but they'd be missing the impact language. So are you guys just greenwashing by putting impact over the things that you want to do, or is it actually a different mindset in impact investing?
My view, it's a different mindset. So the way that we assess impact is ensuring that for every dollar of revenue generated, there is in effect a unit of impact, whatever that may be, and any one of our team, whatever level, whatever experience, can veto based on impact. And I think the challenge is that impact and commercial considerations, you use 2 different parts of the brain. And there's a wonderful article on this actually. It's Staying for Tea, I think the trouble with impact investors' brains. And it's that there is an element where you look at the financials and then you also, and others might disagree with me here, but I think you can't think about both of them at once, that you need to definitely apply an impact lens in order to make sure that you're making an investment that aligns from a social environmental perspective with your investment mandate, and then also look at the commercials to ensure that it's delivering a commercial return. I think traditional investors are just looking at the commercial and they're not looking with an impact lens.
Did you have something too?
Only from a point of view that the dislocation in traditional and let's call it impact investing is that in the traditional sphere, you paint with numbers, you've got a bunch of male, pale, stale people in a room, they're set in their ways, they know they have to be somewhere but they're fearful of where that is, they don't trust it, they don't understand it, so often it's given a tokenism, a token investment. We'll put a bit over there because we tick the box and then we move on. And I guess that's the mechanics, the dislocation there. We need to fix that. If we can fix that, then it just becomes mainstream.
That's good. Adam?
I was just going to add that I think that traditional investing may have a part of their process. They might look at what is the impact or the or consider it in their thinking. But as Rachel said, for us it's embedded in the process and it's part of the assessment criteria, and that takes a whole lot of extra work to figure out, what is. Is the impact of your investment really positive? And you've got to set up to do that. And so an example for us is on a on a solar project is we look at the financial returns of the solar project, but then we also look at the overall impact of the solar project. So depending on what panels are used, you can have completely different carbon footprints with those. So the best in class panel will have a 2-year carbon payback, and the worst will be sort of 16 years, and that's because of the way they make the panels. They use a lot of water and they use a lot of heat in the manufacturing process. So you're getting two very different outcomes. Now, if I'm just a financial investor, I'm just picking the cheaper panel, and the cheaper panel is not the one that has a 2-year carbon payback. So they're the types of things that are front of mind when you're an impact investor.
And Victor?
Can I give an example of a
Yes.
company that I've been somewhat inspired by and sort of, I think, illustrates maybe the type of new thinking that I think is going around on investment? So I was tracking a company called Appeal Science. I don't know if anybody knows that company, but they basically create a biofilm that comes from agricultural waste, and they can reconfigure that biofilm to be a spray-on to fruits and vegetables to extend shelf life, control oxidation, and respiration. And so from a venture capital standpoint, when you look at that company, you look at it in terms of where is the revenue going to come from that company. So, okay, now with that technology, you can get avocados from Southern California into mainland China, which has never been done before. So, okay, now we're going to have, guacamole in, Shenzhen. So, yeah, there's a lot of money we're going to make, from a venture capital side, from that activity. That biofilm also allows you to lower the temperatures in transport vehicles going from the west coast of U.S. to the east coast. So there are big reasons from the venture capital standpoint why you would invest in a company like that on top of just the food waste aspects of it. But at the same time I was diligencing that investment, I saw that in previous round on the Series A, they were getting 7-figure non-dilutive capital coming from Rockefeller Foundation and Gates Foundation into that same company, going to the underlying baseline technology. So it wasn't for some new application. It was non-dilutive dollars coming in that de-risked my investment. But what those foundations saw was a completely different application. What they saw was that the biofilm could help small shareholder farmers. In Kenya, let's say you're a mango farmer, you can't realize the full potential value of that crop if you're just selling it within a radius of other mango farmers. You have to be able to get it outside of that radius to the cities. There's no refrigeration infrastructure. There's no cold chain. So how do you do that? So the foundation saw that application. So they were giving millions of dollars to that same company, to build out that application, while the venture community was looking at it from a opening of markets, perspective. And so that was just a beautiful way in which, impact dollars and venture capital dollars came into the same company for a global purpose. So it was just a great example for me.
All of you have now mentioned ways in which you assess or look at impact, and it's an additional lens or a different part of the brain. I imagine you also need to measure the impact that you actually make. Is that fair? Is that something that you actively need to measure after post-investment? Adam, you used an example before. What are the issues around measuring?
Well, I think that the issues around measuring is something that Victor touched on before, which is there is no one way to measure things, and there's a lot of debate, and there's a lot of different ways of doing things. I think the best you can do is just be very transparent about your measurement process, so that your investors or LPs and other interested parties can see what you're doing, and you're accountable to something. But it's better to measure something than nothing, or to try and come up with a standard. But there's a lot of people out there trying to come up with standards. We haven't found anything that one size that fits all, and I don't think there is. But so again, just to repeat myself, for me, it just comes to being transparent and open and measuring something.
Other comments, Rachel?
Yeah, so we are just in the process of preparing our impact report, and we use the Impact Management Project, which has been a framework that's been developed by a group of impact investors that's starting to become more globally recognised because it's very simple, and you can take different elements of it and use it as a framework that suits you, but there are a couple of elements, things like just the basic spectrum of whether it's the kind of ABC spectrum, whether you are avoiding harm, so excluding alcohol, weapons, etc., to benefiting people and planet, so better than the status quo but not necessarily solving the world's problems, and then contribute to solutions. So is it something that is going to change the world? Is it going to change the either system or structure of the way that we operate? So that's something that we think about in our assessment of impact, and we do measure. It's not always that easy to measure impact, and so an example that I give was one of the companies I spoke about before, Perks, which is a medication adherence app. It's trying to get people with a chronic condition to take their meds regularly to avoid hospitalisations. So that's hard to measure, avoided hospitalisations. So they've done a clinical trial to demonstrate that adherence leads to better outcomes. So there are circumstances where we do need to use proxies or research to identify impact.
Terry or Victor, any comments on measurement?
Yeah, I think for individual companies, it's a pretty straight ahead approach depending on what company it is. So for instance, Fruit Shot Global, we did a $3 million investment into a company called Trace Genomics, which is sort of like a human genome project for soil microbiome. And so largest DNA database. They do field testing, so they'll go to a farm, use their test on DNA for microbiome consortia, and do predictive analytics on yield benefits. So you could track pure acreage, how many acres, are those field, clients do they have? So on a year-by-year basis, on an impact basis, okay, 1,000 acres, 10,000 acres, 100,000 acres. And then you can also do tracking of yield improvements on the crops that they're doing, their work on. So I think for each individual company, you can track impact in I think the way that, you're thinking about it. Yeah.
Is there any data yet, as a relatively young term, I don't know about a young industry, but a relatively young term, is there any data yet about the effect on financial returns? Victor, you're thinking that it's a logical way to enhance financial returns, but are we paying a penalty in deal flow, in the amount of choice you have, or in the returns you can get financially?
So I don't think so. There has been research done to date, and I don't think you do need to trade off. So the Responsible Investment Association of Australasia, so RIA, much easier with an acronym, has a report that they look at the impact investment landscape and returns, etc., that's being generated from impact investment. And, we are able to get commercial returns through our investments, and people are realising that, and you'll see that through the growth of the impact investment industry as well, and people are starting to, traditional venture capital funds that we co-invest with are starting to use impact terminology because I think they're seeing the opportunity too, similar to what Victor was saying, that it's just good business to have a company that's doing good. Yeah.
Okay.
I actually think there is a trade-off. I don't necessarily agree with that. I think it's an acceptable trade-off, but not forever. I think it's as we transition, as we sort of make it one industry, investing in general with an impact culture, if you like, or whatever the right term is. But I don't, as somebody that's hands-on running our family office, we go out and look for these type of investments. And there aren't a lot of good ones out there. I mean, there are poor mainstream investments as well.
Yes,
it's not just in this area. But I find that you tend to compromise a little bit. You're a bit more forgiving because there aren't a lot of good investments out there. We can count and be charitable in the way we count. I mean, there is triple bottom line. You would all know about that process, or B certified companies. There are a lot of people out there a lot smarter than me that have tried to measure and put infrastructure in place. But I don't think it's necessarily a bad thing. I don't think we should be embarrassed about it, but it can't be forever. We need to make it mainstream.
Right. Gotcha. And in the pools of capital that you people are managing, I imagine a lot of that's coming from institutional investment. So talk to us about the institutional attitude towards impact investing. Is it a sea change? Is it a bleeding edge? What's happening in the world of the big funds that are investing in your pools?
I think they're coming to the game now. It took a while. And I don't think they, especially in food and agriculture, there isn't a lot of institutional knowledge around that. It's one of the later classes that I think they've started to look at. From an investment standpoint on the venture capital side, it clearly started with family offices, high net worth individuals. Silicon Valley got into the game, I think maybe for some of the right reasons, but also, I think, their approach to the sector is very different from the way family offices approach to it. So yes, I think it's maturing now from a food and agricultural standpoint. Pension funds starting to look at it, certainly the big banks, investment banks looking for it. Beyond Meat's changed everything in that regards. It's set the sort of the North Star now that there's a way to get in, and there's a way to get out. I don't think there was a real precedent for that prior to that. I think in your intro you said something about, nobody has, sort of a sure pathway into impact investing. I think the bigger concern, there was no way out of impact investing, but I think Beyond Meat, sort of changed that
because of a stellar return.
Because of stellar return.
Yeah.
And, I can tell you a little bit about that investment if it's interesting, to people, because I think it gives kind of an insight in the change in the dynamics over the last, 5 years.
Talk about Impossible as well on the way past, Impossible Foods.
For me to comment on Impossible?
Yeah.
I'll comment on that. So Beyond in 2012, when I started tracking it, was a small, sort of company. What I liked about it was that I just believed that there was going to be a fundamental shift in the amount of meat people were eating. And it was more from a flexitarian standpoint. It wasn't from a militant, sort of disruptive, sort of perspective. But it takes, sort of a long time for a company like that, to develop. And along the way, there's a lot of doubt, and there's a lot of dynamics coming into it. Silicon Valley came into the investment into those kind of companies, and it changed the nature of valuations and kind of the pressures on the company. But there's one story I'll tell that I just think is one of the great stories from the early days of Beyond Meat, was that revenue was hard to find. I mean, we were in the frozen aisle. The products were not great, but they were appealing to a certain small sector, of the consumer public. And so any revenue at that point, that was meaningful was attractive. And we got a inquiry from Wendy's to do like a burger, but it was going to be like a bean burger, almost like a typical veggie bean burger. And so I was on the board, at the time, and it was a big debate. I mean, this was like $10 million a year top line revenue, a small margin, but $10 million at that time was, looking pretty good. So there was a big debate about it, and one of the investors who never came to the board meetings but was always a voice on the phone was this guy who may or may not have been one of the founders of Twitter. And he basically, just started screaming into the phone, which was like, we are not doing a friggin' bean burger. That is not what I signed up for. That is classic distraction. We have to stay on our mission. And it was a real defining moment. And from that one input from him, everybody was like, you know what? He's right. That's not what we're, sort of here to do. Stay on mission, stay focused, and then go through the hard work of getting that mission, realized. And so, obviously that worked out pretty well, but it was a long road. Yeah.
That's excellent. Are there ever, when one puts this lens on and really starts working hard about impact, are there ever any unintended consequences? Are there any things that sometimes go wrong or that you've got to think more complex around? Rachel.
So there's an example that's used around about vaporizers, the e-cigarettes. And that was an investment that was initially thought of as an impact investment. And what they found was that more teenagers started to smoke using e-cigarettes than had previously been smoking cigarettes because it was cool. And so that, I guess, is an example of the unintended consequences that can occur when you think you're doing a good thing. And then, things manifest into a way that you weren't expecting. And so for us, touch wood, we haven't seen any unintended consequences as of yet. But it's kind of the unknown unknowns. You never really quite know. You can guess at what unintended consequences may be, but that example was very well intentioned. It just didn't turn out the way they'd planned.
Yes. Adam.
Yeah, we've got an example that's very recent. We got very close to signing a deal that had great financial returns. We thought had a great social benefit. It was a housing project up in northern Queensland, and it was to create accommodation for women and young children who needed crisis accommodation. And so it was acquiring some old units around port, around Cairns, and refurbishing them, and then we would have a long-term contract with the government, and the government would put in women and children who needed the crisis accommodation. And so prima facie, that looks like a terrific investment, great financial returns, great social impact. One of the last things we had to do was go around and see all the accommodation and the land and buildings we're buying, and what we found when we did that these buildings were already housing some of the most vulnerable people in Cairns, and so by us investing and doing this, we were going to be evicting those people, and they would go to the bottom of a list to get cheap housing, and there is a lack of cheap housing in Cairns. So by going ahead with the project, we were creating another problem, and so we pulled out of that project as a result. So they're the types of things that you're faced with, and it can be really difficult, and you have long debates about what is the net better thing to be doing. And there's no right answer. It's a judgment call at the end of the day.
Any other examples? If not, then both Victor's comment and I suppose the idea of social housing obviously brings up the concept of non-dilutive funding, of investing alongside of social programs, investing alongside maybe even of World Bank debt and the likes. Victor, you sort of opened that can of worms by talking about blending capital. Do you think that is where impact investing will take us, instead of the simpler version of I put my check in, I own the shares, I sell the shares? Anybody?
Yeah, so I sit on the board of our foundation, Catalyst, that's what it's called, and we look at trying to catalyse impact investments through philanthropy and also different types of investments that may be considered sub-commercial, to then create a greater universe of impact investments. We've also read about and talked to Eunice Social Business, who invested through a loan to a water company, and what they did was they actually subsidised the interest payments for the company itself, the water company, and they then on the other side topped up the investment that was made by the private counterpart. So I think there are ways to get more capital into social and environmental causes through clever combinations of philanthropy, sub-commercial, and all the way up to impact investment and traditional investment.
I'm going to, just a second, I'm going to open the floor to other questions in a minute, so please think about them. Anybody that wishes to ask, or to use the app to put a question through. Victor, you're about to say something?
I would just say, whether from an impact lens or just an investment lens, I think blended capital has a real sort of future, because it sort of makes sense if you look at an evolution of a company. So if you have like philanthropic dollars, that can come in early to help sort of de-risk a research and development, project that, a lot of funds don't want to take technology risk, or that the founder doesn't want, a lot of dilution, at, the beginning. And a lot of the problems that come in companies in their life cycle is because all of the funding sources and stakeholders get misaligned. And so part of what blended capital allows you to do is to keep the alignment, I think, better, where everybody's on the same team for longer. So if the founder has more of a stake in the beginning because there's non-dilutive capital that's, sort of come in, then the venture guys come in and they take that, sort of commercialization, risk, and that's all, sort of fine. But then if they can be protected, by the fact that venture debt or debt can come in earlier, it's all about protecting the life cycle of the company and minimizing failure, because this stuff is hard and it takes a long time. And you don't want a company that's so capital intensive that it just buckles under the pressure of all of that capital coming in. So all of these different capital sources, I think, are a good thing ultimately.
Terry.
Just to add to that, Andrew, Victor, that's a very good point. I think the blended capital just does two things for me. It's a point of validation, and it also builds momentum. It's all about momentum, confidence in the investment, and that just builds layers and layers. So, you start small, you introduce various stakeholders or different types of capital with maybe different purpose, but ultimately that momentum gets built to hopefully a successful investment to reward everyone for the risk along the way.
I just referred before to the put your money in, buy the shares, sell the shares, the old-fashioned way. Is your life more complicated because of that? Do you have more things more moving parts to manage in impact investing than traditional venture capital?
Well, I only met Victor backstage, and I reckon he's got a very complicated life, so he should be answering this question.
I mean, there's more. I don't know. It's a lot of fun. I mean, first of all, I think we're all having a pretty good, time. If you're going to be an investor into food and ag, this is the time to be doing it. This is a once in a lifetime, generational shift. So yeah, it's probably harder work, more things to do, but it's sure a lot of fun. Yeah.
Are there questions from the floor? Is there any questions? Oh, sorry, right in the front left here. Cal, thank you.
I'm just curious about your approach to startups and scale. I'm in the plastic recycling world, which is a very interesting time right now, with some stuff happening globally with China and that sort of stuff. And we launched off a crowdfunding campaign, and we've had a lot of interest to scale very quickly. And some of the investors we're talking about, there is capital matching grants out of state governments and federal governments, and some of the impact investors we're speaking to don't want to get out of bed unless the deal is between $20 and $100 million. So we're looking at a network of factories, but then we're so small, it's a big jump from where we are now. How do you manage a startup and scale and projects of that sort of nature?
Rachel, I imagine you're comfortable in that space.
Yeah, so it depends on the fund itself. So for us, we write $100,000, $500,000 checks as our two kind of initial check sizes for the very early stage at seed, and then a bit later Series A will write up 500,000. So that they're not big dollars, and we don't need the round to be, $20 million. Actually, it's probably a bit late if that is the case for us. And so it depends on who you talk to around what the capital requirements you need versus the investor match. I think that's really important to understand. The balance between the investment and the scaling. For us, we invest in tech-enabled businesses to facilitate scale without a lot of capital investment required. So we don't invest in factories, manufacturing, that kind of thing. If it involves an initial outlay of, say, 20, 50, 100 million, because that's not the right type of investment for us through our investment mandate. So it's a tricky one to answer because it depends on who you're talking to and whether you're actually talking to the right investors or not.
Any other questions from the floor or from the app? Yes, over here.
So a few weeks ago, I was at the Melbourne Entrepreneurship Gala, and I met this person who held the belief that this boom in social enterprise and impact investing might be having a negative impact on the not-for-profit sector, because there has been this boom in businesses having positive impacts that now philanthropists or people with money in their pockets are looking to get a financial return on the positive good. But that isn't necessarily an option for all forms of social good. Like, with the need for not-for-profits, do you think that impact investing is having an impact on the amount of money going into not-for-profits or charities?
Any views? Adam.
I think for us, we say this: if we're taking $1 from philanthropy, then we've failed. What we're trying to do is take money from. We want to convert people's traditional investments into impact investments, and that's why we're very returns focused. So I think that's where it can get a bit tricky when you start talking about compromised return type investments, and you're starting to, as a promoter, if you're going to foundations and you're going to those types of organisations for funding, then it is a bit more of a confused conversation. Having said that, there is a place for both, and Victor was talking about how there are blended times where blended finance is important, and you want a bit of everyone's dollars in a particular deal. But I can understand why some people in the non-for-profit sector might say that. We're very focused on trying to convert the traditional money into impact.
Further questions from the floor or from the app? Carl, anything?
Yeah, sure. I've got a great one here. Given that we're at an ag and food conference, it's talking about regenerative agriculture and the place for regen ag in the impact investment space. The question's really around how to. Given the kind of murky nature of kind of science and around measuring carbon capture from your regenerative agriculture, is there a place for impact, and if so, how does it navigate the measurement side of it?
Any comment?
I'll do a little on the measurement side. So one of the recipients of the Groundbreaker Prize, which came from my nonprofit, is a platform that was generated at the University of Colorado, and it's an open source modeling platform in which you can basically do crop selection, do rotations, overlay soil type, weather data, yield targets, And then there's an embedded GHG calculator and a carbon sequestration calculator, so that you can basically think about regenerative agriculture, think about your crop selection, and actually be able to model in advance in a predictive sort of analytics tool how much carbon is being sequestered and how much is being released into the air. So those type of tools now are going to become more and more important if you're going to start a sort of a carbon market, if you're going to be able to hit different sort of carbon targets as agricultural companies or as a farm. So yeah, I think the measurement piece is super important, and there are tools that are starting to emerge to be able to do that. Yeah.
Great. And probably a follow-up part of the question was just around probably the economic side of it, in terms of there is a suggestion in the question that returns are expected to be lower in the regen ag space. Any comments on that?
Returns for what kind of regen ag? For grain, for livestock, for integrated?
Let's go with broad acre cropping.
For what?
Broad acre cropping.
Oh, broad acre cropping. So, no, I think actually the opposite. I think there's a lot of opportunity there. So there's a pilot project that we helped to put together. It's between General Mills and a land fund. The land fund basically bought a 35,000 acre grain farm, but did not go forward with that purchase until two things happened. One, there was a regenerative agricultural tool set that could come in and do the conversion. Right, so how do you most effectively convert the land from conventional to organic? And then most importantly, on the economic side, how do you basically use future contracts to do the offtake for 5, 7, 10 years, so that the purchase of that land is completely de-risked by the amount of income coming off that land that General Mills is subscribing to in order to scale up Annie's with wheat, and that General Mills would be willing to pay a premium on top of an organic price for the security of knowing that their supply chain can go secure for 5, 7, 10 years in advance. So I think there's a lot of opportunity in there.
Great, thank you.
How time flies when you're having fun, and we're out of time. But gee, that was interesting. I'd just like to sum up by saying it's lovely to hear a group of people that have come into this space from their diverse backgrounds. It's good to hear the issues they're grappling with, such as around management. It's also good to hear of the momentum in the space, and we can see that momentum building. The concept that it may become mainstream in the near future is just exciting to everybody here. So I guess I'd just like you to thank our panel for sharing their input, and I'd like to thank you for your attention today.